Spring 2023 is almost here, and the U.S. housing market is showing no signs of crashing, not even close. While there are some who believe that we are on the brink of the worst housing crash in recent American history, the current price stats are proving them wrong. Although there was a slight price decline at the beginning of 2023, it is nothing compared to what happened at the beginning of 2020. About 3 years ago, economies across the globe were hit hard by the outbreak of COVID-19, including real estate. According to the Case-Shiller Index, the price of a medium home rose to a staggering 43% from March 2020 to June 2022. This incredible rise was never thought to be possible. Investors were overjoyed by this unprecedented growth, while owners benefited by pulling out record-high equity. Meanwhile, buyers watched hopelessly as prices continued to soar month after month. After 27 straight months of unbelievable growth, the market finally took a breather in June of 2022, with the Case-Shiller topping out. As mentioned earlier, it had increased by 43% since March 2020. However, the story has finally started to change. For the past 5 months, prices have declined, declining 3.6% from the peak. But let's put things into perspective. To fall back to pre-pandemic levels, the Case-Shiller will need to decline an extra 28%. Although a 3.6% drop may seem insignificant, there is plenty of evidence suggesting that this is the start to the next housing market depression. Shocking new data is being released every single week, including the recent Case-Shiller report revealing that prices have now declined for 5 consecutive months. This may not seem alarming, but let's take a closer look at history. Since 1986, the market has almost never dropped more than 3%, with the only exceptions being the 3.05% drop in 1990 and the devastating 2008 housing crisis. Therefore, this small blip on the graph is extremely significant and indicates that something big has changed in the markets. As the real estate market begins to show signs of a crash, it's important to understand the dynamics that will drive prices down. Many experts believe that we are currently in what is called the denial phase of the crash. This is when private sellers refuse to sell at a lower price, creating a misconception of a healthy market. However, history has shown us that it's not these private sellers that will move prices in any significant way. Instead, the group that has the most impact on pricing in most real estate markets is the builders. These multi-billion-dollar corporations have whole teams dedicated to setting prices and moving inventory. They understand the supply and demand better than anyone else, and they greatly benefit from lower prices, making it easier to sell units. Sure, the Case-Shiller graph may look okay at first glance, but it's not telling the whole story. In fact, we've seen a clear trend in recent months where almost every major home builder has reduced prices and started including incentives like rate buydowns just to entice buyers. Don't be fooled by the numbers on a paper. The reality on the ground is quite different. With builders struggling to move inventory and stay profitable, they're willing to make significant concessions just to make a sale. This is great news for buyers who are looking to get the best possible deal on a new home. If you are considering buying an existing home, hold on to your decision for a moment because recent earnings reports from builders reveal some serious issues within the market. The impact of these actions may take some time to make its way into the existing home market, but there's no question that these developments in the new home space will have a huge impact. Imagine a new home around the corner suddenly slashing its price by 15%. That puts it on par with the existing one you were looking at. It's a no-brainer that this will most likely convince you to buy the new home. Why? Because there's always a premium between the existing home and the new home. New homes are always the ones that anchor prices. While it may be hard to accept, the evidence is clear that a new home slowdown is on the horizon. However, this doesn't mean you should panic and sell your property immediately. The thing about real estate crashes is that it takes a really long time to get going. Just look at the last crash to get a sense of the pace. Prices peaked in July of 2006, but from that point, home prices would start to fall at a snail-like pace. In fact, 1 year after the peak, in July of 2007, the Case-Shiller was down only 1.95%. That's just a little more than half of what we've seen in the last 5 months. Even 2 years past the peak, in July of 2008, we were only down 10%. It took the Case-Shiller 5 years and 7 months to complete its collapse, bottoming out in February of 2012 after a 27.4% drop. It would take an additional 5 years for prices to recover and return to the 2006 peak. The facts are clear. A real estate crash is coming, but it will take time. Let's face it, Owning a home has always been a big part of the American dream, but right now, that dream is in danger. The market is at a crossroads, and we need to take a hard look at the facts. The truth is, home values don't just drop overnight. It's a slow and painful process that starts with the builders and flows down throughout the market. It's a process filled with frustration, regret, and greed, but it's a process that we cannot ignore. To put it into perspective, let's take a look at the percentage of the average American's income used to pay for a mortgage over the last 25 years. For the most part, 39% of the average American's income was used to pay for a mortgage over the last 25 years. However, from about 2006 to 2007, that number rose to a staggering 45%. This made home prices unaffordable, causing the housing market to crash, bringing down this percentage to 36% starting in 2008. From here, this percentage would creep back up to the 39% average. Unfortunately, from 2020 to the end of 2022, the average amount of income used to pay for a mortgage went from 35% to a new all-time high of 52%. The numbers don't lie, and they are painting a concerning picture for the real estate market. This is unsustainable, and we are well above the relative prices of the 2008 real estate bubble. It's natural to question what makes this time different and whether history will repeat itself. When we examine the key factors that affect real estate affordability, it becomes clear that something has to give. Income levels are unlikely to rise to catch up with the current prices and interest rates, which are set to remain elevated. This leaves only one variable left: prices, which is why many are calling for a crash despite the record low unemployment and the growth of incomes over the past 5 years. This trend cannot continue, and we must take action to prevent a market crash. As we enter into a new year, it's becoming increasingly clear that demand from normal, everyday Americans is crucial to keeping supply low. Without this demand, we could be facing an uphill battle in the housing market. As the inventory situation begins to play out, we'll likely see prices fall, and this process could take years to play out. However, we need to be prepared for the possibility of a long, painful bear market that could be just around the corner. The evidence is clear. Builders are slowing down, slashing prices, and increasing incentives. This action will affect the rest of the market, and we need to be prepared for what's on the horizon. The similarities between this past summer and the summer of 2006 are hard to ignore, and it's important to remember that the next 3 years may be headed in the same direction. So the question remains, are you prepared for the 2023 housing market collapse? Thank you for tuning in, and don't forget to like and subscribe to our channel for more updates on the latest news and analysis.